In this week's video, we'll cover numerous long-term signals that support the bullish case for stocks. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Since all investment decisions are basically opportunity cost decisions, risk-on, risk-off, or ratio charts can be very helpful, and many of them are tracked by the CCM market model. This is stocks versus bonds. This is 2006 on the left side of the screen, and in this case, this is early 2013. We know that when we have a long-term consolidation and indecisive period, often when we get a breakout, an easier period with a more discernible trend follows the more difficult period with a lot of indecisiveness. And in this case, the easier period with the more discernible trend lasted 2.5 years. This is a 2.5-year period where the probabilities tell you that the odds favor clearly owning stocks over bonds. If we fast forward to the present day, we have another long-term consolidation box and what now appears to be a bullish breakout. This is a quote from the book Trend Following. Let's walk through it piece by piece. A move, so in this case the ratio moves from point A to point B, followed by a sideways range. So a move followed by a sideways range. A move followed by a sideways range. And the move and the range overlap, meaning it's very, very difficult to discern in here that you're going to start a trading range, but you can start to figure it out on this end here. A move followed by a sideways range often precedes another move of almost equal extent in the same direction as the original move. What exactly does that mean? The sideways range often precedes another move of almost equal extent in the same direction as the original move. Here's the original move from the bottom of the consolidation box to the top of the trend. It basically says this could be preceding another move of almost equal extent in the same direction as the original move, which might hypothetically look something like this. The trend from the bottom of this consolidation box to the top of the other consolidation box lasted over 3 years. If something similar happened and this tenet applied, then we might see something like this inside of this green box. The purpose here is absolutely positively not to forecast anything. This helps us understand that the market that was difficult may be followed by an easier market. And when we understand this, it gets a lot easier to switch to more of a long-term buy and hold focus, as long as the data in the model says that's what we should be doing. In the last few weeks, we've been talking about improvement in economically sensitive areas and sectors of the market and ETFs. This is XLB Materials. It was inside a consolidation box for 1,438 days. It just broke out of the box here in a bullish manner. This chart is as of December 8th, 2016. The longer we go sideways, the bigger the move that we can expect to get when we get a bullish breakout or bearish breakdown. It appears as if we have that bullish breakout. A move from the bottom of the box to the top of the box when resistance is in play can be followed by a move from the top of the box to the bottom of the box. Therefore, from a risk management perspective, when you're coming off this low here, you have to respect the fact that you're still in the box. And until price proves it in here, principal preservation has to take a relatively high priority. Because if price is rejected at the top of the box here, this is what could follow. Now, in the present day, we have price supporting what looks to be a bullish breakout. If this look holds here, now you're shifting to growth and buy and hold, taking precedence over principal preservation because the odds are improving. This area of previous resistance has been exceeded here for the first time in over 4 years. The longer XLB holds above the box, the better in terms of long-term bullish probabilities. Hindsight's always 20/20, so this looks really, really easy to say we should have bought down here. However, keep in mind, this is what this chart looked like before the U.S. election. There's no bullish breakout from the box here. We're still inside the box, and if anything, it looks like we might be heading down toward the lower end of the box. This move from here to here represents a 30% loss roughly in XLB. So when you're up here, your risk-reward is questionable because you might get another 30% loss and go to the bottom of the box. Once you break out, then the probabilities and the risk-reward start to improve. So this is a very long-term 4-year consolidation box, and the concepts that we've covered in the past still apply to XLB from a probability perspective. This is a daily chart of the S&P 500 index as of Thursday, December 8th. We know we have our long-term consolidation box, and we know the probability of good things happening is higher once we break out of the box. And we also know that when price is in the box and we're at the top of the box, we can move back to the bottom of the box. So we've seen significant improvement relative to the box. This is before the election, and this looks like a bullish breakout and a failed bullish breakout. Sometimes when you get a failed bullish breakout, you might move rapidly in the other direction. And we also know from past videos, this is 2001 here, when you get these long-term consolidation boxes, it's possible that you get a bullish breakout or a bearish breakdown. So when you're in the box, you have to manage risk more closely, especially when you have a 200-day rolling over and a 50-day here. 2001 looked very, very similar to the S&P 500 in 2016. When we broke out of the box here, the S&P 500 lost an additional 42% from point A here to point B here. Similar situation in 2008 when you're in the box, and in this case you break down to the lower end of the box. The loss from this point A here to point B was 47%. And once again, earlier in 2016, this profile here looks very, very similar to the profile that we had in February earlier this year. And we're going to tie all of this into our risk management strategy from earlier in the year and contrast that with our current risk management strategy. Math tells us that capital preservation is big. Remember, we covered that if you lose 47%, you have to make 89% just to get back to break even. While this quote here speaks to a trading time frame, the concepts apply to our longer investment time frame. George Soros has a philosophy that I have also adopted. The way to build long-term returns is through preservation of capital and home runs. For us, when we get a look like this, or the look that we had earlier in 2016, which is an unfavorable look from a risk-reward perspective, we would prefer to focus on preservation of capital. We're not nearly as worried about what the indexes are doing. We're more concerned about preserving capital. And in our case, the home runs, we're not looking to hit home runs necessarily, but we're looking to put our capital in harm's way when the odds are in our favor, which was not the case earlier in the year. This is the peak in 2000, 2008. This is January 2016, the 200-day and the 50-day. This look here is a preservation of capital look. We also know from past videos that when you're in the box, even when this 200-day starts to turn up, we know we can go from the top of the box to the bottom of the box, so you still have preservation of capital on your mind until price can prove something to you and you migrate at a slower rate until it can do that. When we move out to a longer time frame, this is 1989 here, this is 1998, the consolidation periods are the periods where you focus on capital preservation over growth. Then when the odds are clearly in your favor, now you switch to a growth bias over capital preservation. And the way that you manage risk is if the information that you have in hand changes, then you just revert back to a capital preservation strategy. Consistency is a big part of running a model. That's why we keep showing the same things over and over again. If they were relevant months ago, they should still be relevant today. This is our 30, 40, and 50-week generic for illustrative purposes only weekly moving averages, which was the signal that had only occurred 10 other times in the last 35 years. If you want to find that full analysis, you can Google this title here. And clients and regular viewers might remember that in that analysis, on average, after we got that long-term probability signal, the market rallied for an additional 108 weeks. And these longer-term signals were one of the reasons why we were open to bullish outcomes after the election. This is the 3 moving averages that we just discussed on October 14th. They definitely have a longer-term bullish bias before the election. They don't really look anything like the bearish bias in 2008. This is a high-risk profile where capital preservation is your #1 priority. This is a growth-oriented profile here, so if price can prove something to you, growth is the priority. The year 2000, capital preservation is a priority. October 14th, 2016 really doesn't look anything like this high-risk period here before the dot-com bubble burst or as it was bursting. If we fast forward to the present day, we still have a constructive look from a risk-reward perspective, and our bias is to err on the growth side until the evidence says otherwise. This look before the election and after the election is one of many reasons why we had the confidence to move so rapidly after the election, and also why we had the confidence to hold our base growth-oriented positions through the election. When we have a heavy growth bias to our allocations, as we do now, the way that we manage risk is by monitoring the hard data. The hard data will tell us whether we should maintain that stance or whether we should make some defensive adjustments. So it makes sense to check in on some of the things that were leaning bullish several months ago and several weeks ago and see if they still lean bullish. Our monthly Bollinger Bandwidth signal is still in place here, and we still have a successful bullish breakout above the long-term monthly consolidation box in the S&P 500. If you want to find this analysis, you can Google this title here and find it on See It Market. Our confidence to move rapidly after the election is higher because we have numerous pieces of hard data that told us that that was the prudent thing to do from a probability perspective. Some of you may remember way back in September, we had an analysis that looked at the S&P 500 relative to the VIX, and we looked at 2 other cases from history where the ratio moved in a similar manner, and after that, very good things happened in the stock market. How does this look today? It still looks constructive with the S&P 500 relative to the VIX monthly here as of December 9th, and MACD still has black above red. If you want to find this detailed analysis, you can Google this title here and see the bullish analysis from September 23rd, 2016. One of the common themes of many of the signals that we've covered and we're reviewing and updating again today is they represent shifts from risk off to risk on from a very long-term perspective. You might remember from Short Takes, August 24th, 2016, we said the probability of good things happening was higher when the 50-week moving average for this volume indicator turned up as it did in 2003 and as it did in 2009. You can find that detailed analysis by Googling this title here. How does this look today in December? Is it still leaning bullish from a probability perspective? The answer is yes. The slope of it is still positive here, and you can see it flattened out in 2011 and 2012 and then turned back up just before a big rally in the S&P 500. This is the volume indicator. This is the S&P 500 where my cursor is. So right now, in terms of the weight of the evidence, this still looks good too as of December 9th. So linking back earlier in the year, we were in preservation of capital mode. Let's take this chart forward to the present day. Remember, we said the weight of the evidence allowed us to keep an open mind about better than expected outcomes after the election. Here's one example. You can find this post on Short Takes by Googling this title here. It was posted before the election on October 31st. Let's update the look of these charts. It's a chart of the S&P 500 as of Friday, December 9th. This is the 200-day moving average in red that helps us with the longer-term trend, and this is the 50-day moving average in blue that helps us with the intermediate-term trend. All of this helps us filter out the day-to-day noise and focus in on the trends and the probabilities. You can see heading into the election, we had some concerns about the intermediate-term trend, but we noted in that October 31st post that the long-term trend still looked constructive heading into the election. In fact, this here doesn't look anything like this low probability period here in 2000 and 2001. And as we've covered in past videos, something as simple as the slope of the 200-day moving average can be very, very helpful. And the fact that we had this turn up here earlier in the year and the positive slope was one of the reasons why we had an open mind about all outcomes, bearish and bullish, heading into the U.S. election. You can see here you're migrating from preservation of capital being the primary objective to somewhat of a mixed objective as we start to improve. Now we're focusing on both preservation of capital and growth. Once we break out and get the more constructive look, growth is by far and away the #1 priority until data deteriorates, and then preservation of capital will come back into the equation. We don't anticipate that. We wait to see it. And right now, as of Friday, December 9th, we don't have anything in hand that says we should switch back to preservation of capital as our primary objective. We can take these same concepts here with the 200-day and the 50-day. So this would be our full-bore bearish look with the 50-day below the 200-day and the slopes of both down. This is full-bore bullish. The 50 above the 200 and the slopes of both of the moving averages are up. We can see some of the longer-term shifts here. This is risk-on, risk-off materials relative to bonds, December 9th, XLB relative to TLT. We have a turn in the 200-day moving average in 2016 here in December. We've moved from a full-bore bearish look to a full-bore bullish look, favoring XLB over TLT from a probability perspective. Similar situation here. This is our SP high beta relative to SP low volatility, so economically sensitive sectors relative to defensive sectors. This still looks good as of Friday, December 9th with a bullish turn here and a full-bore bullish look currently in favor of economically sensitive sectors relative to defensive sectors. It doesn't mean the defensive sectors necessarily would lose money. It just says the probabilities favor econ-sensitive outperforming defensive sectors, and that's exactly what happened this week. SP high beta was up roughly 4%. SP low volatility was up but half of that, roughly 2%. Continuing on with the shift, you can see why our portfolios have shifted. When the odds improve, we have to start to shift the portfolio. Energy relative to bonds, full-bore bullish look. And this is a longer-term shift here. This is the 200-day moving average in 2014, 2015, and it turns up in 2016, saying from a risk-reward perspective, this is probably a good entry point for energy relative to bonds, as long as this chart continues to maintain this bullish bias. Same themes, 200-day moving average, base metals relative to bonds, metal stocks relative to shorting the S&P 500. Look how weak metal stocks are. Over here, they can't even beat shorting the S&P 500. And now you can see we have a full-bore bullish look in favor of XME relative to SH. Similar situation with the energy complex. couldn't even outperform SH, and the trends were favoring shorting over owning energy stocks. That's different today. Now the long-term trend and the intermediate-term trend favor XLE relative to SH. Similar situation here. This is a base sideways consolidation in XLE relative to SH, 2011, 2012. Breakout, harder markets are typically followed by easier markets with a more discernible trend. Now we're looking at 4 years of indecisiveness. We enter this box here in 2013. We go to the top of the box. We come all the way back down to the bottom of the box in early 2016, but we're still in the box until recently. Now we have what appears to be a bullish breakout out of a 4-year consolidation box. The longer our market goes sideways, the bigger the move that we can expect to get when we get a bullish breakout or bearish breakdown. Right now, this chart looks constructive. It doesn't tell us anything about what's going to happen other than the odds look favorable right now. From an opportunity cost perspective, you'd rather own SP low volatility or defensive sectors in 2015 over economically sensitive sectors. Now the opportunity cost analysis favors the economically sensitive sectors. How important can that be? And how important is it for us in our model to move quickly when the opportunity cost odds change? If we use a relatively extreme example, we can see it. These are ETFs here. This is the price of the ETFs as of the close on Election Day, so before we know the results of the U.S. election on November 8th. This is the percentage change between Election Day and the close on December 8th. Banks, KRE, gained 27.15%. Contrast that to TLT, or long-term treasuries, which lost 8.54% over the same period. To illustrate the opportunity cost impact, if we invested $1 million in TLT on November 8th and lost 8.54%, we would have lost $85,402. Compare that to selling TLT on this date and redeploying the capital into KRE. Instead of losing $85,000 on our million, we would have made $271,000. The delta between the two is $356,000, or over 35%. This is an extreme example in this case, but it applies to all cases. Even if you can make 1% more consistently, compounding tells us over the long term that will add up. Thus, our game plan going forward is the same as it always is. We'll look at the hard data. As of December 8th here and as of December 9th, this still looks constructive. As long as that is the case, then we'll err on the side of holding our current positions, or at least staying in growth-oriented positions. If this deteriorates and all of the signals and indicators and risk-on, risk-off ratios that we've covered in this week's video start to deteriorate, then we can move back to more of a preservation of principal bias. But right now, when the odds are in our favor, it's extremely important that we maintain a growth-oriented bias. The objective here is not to forecast. It's to monitor and adjust if needed, or monitor and leave alone. The only way we can monitor properly is to head into next week with that flexible, unbiased, and open mind, and we have to be open to all outcomes, from wildly bullish to wildly bearish. Price will be our guide. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.